Welcome to this deep dive. I'm really glad you could join us today
Yeah, it's great to be here.
because most of you listening already know that a massive top-tier salary doesn't automatically equal wealth. You're familiar with the basics of personal finance.
Right, the fundamentals.
Exactly. But what we're looking at today is a fascinating and honestly a slightly terrifying modern phenomenon regarding how high earners actually live.
Terrifying is probably the right word for it, yeah.
It really is. We're examining a situation where earning an incredible income not only fails to buy you financial peace, but paradoxically seems to create even more anxiety.
Uh,
Our mission today is to dig into the structural traps these high earners fall into, the psychological weight they carry, and most importantly, how to actually engineer a way out of it. Okay, let's unpack this. The data we're looking at points to a growing demographic of urban professionals, and it centers around an acronym HIII.
that's right. HIFI stands for High Income, Fragile Inside.
High income, fragile inside. Wow.
Yeah, it's a brilliant, if slightly uncomfortable way to capture the reality of modern affluence. When you look at the HFI demographic from the outside, they look incredibly secure, almost bulletproof.
Right, they have the lifestyle.
Exactly. These are people with the beautifully curated homes, the premium cars, the impressive international travel habits, and the seemingly robust investment portfolios.
They look like they've made it.
They do. They're providing generously for their families. But on the inside, there is this persistent, gnawing question keeping them awake at night. Will this really be enough?
Will it be enough for retirement?
Yes. They're secretly terrified of the future.
And we should be clear right up front, we aren't here to judge anyone's spending habits or point fingers.
No, not at all.
This isn't a lecture on cutting out lattes or avocado toast. It's about understanding a fundamental structural flaw in how we approach money.
Right, the mechanics of it.
It's about the mechanical difference between generating a high cash flow and actually building unshakable, resilient wealth. Because the research reveals that a strong salary creates the appearance of wealth, but it absolutely doesn't guarantee financial independence.
It really doesn't. And that's the core tension for the HIFI individual. They find themselves trapped in this weird purgatory between prosperity and pressure.
Prosperity and pressure.
Yeah. They certainly aren't poor by any stretch of the imagination, but they don't feel secure either. They're earning more than they ever have in their lives, but they're often worrying more as well.
The anxiety just scales with the income.
Exactly. And a massive driver of this underlying anxiety is the trap of the high fixed cost lifestyle.
Yes, the hidden drains. When you have a high income, it is so easy to lock yourself into high fixed costs.
It happens before you even realize it.
We're talking about heavy mortgage repayments on an upgraded house, expensive car leases, specialized enrichment classes for the kids.
Don't forget the insurance.
Right. Hefty insurance premiums, financially supporting extended family, and the expected baseline of regular travel. It just compounds.
What's fascinating here is the psychology behind how these expenses pile up. When we analyze the HIFI lifestyle, this isn't reckless, wild extravagance.
It's not buying a private jet.
No, it's not someone going out and buying a fleet of sports cars on a whim. You can look at each expense in isolation and completely justify it.
Sure.
A better home in a safer neighborhood reflects family priorities. Those expensive coding or language classes for the kids, that's just an investment in their future.
Makes total sense.
Right. And comprehensive insurance is simply prudent planning. But when you stack all of these highly justified expenses together, you build a financial structure that is incredibly expensive to sustain.
And notoriously difficult to unwind if your income ever takes a hit.
Exactly. It's lifestyle inflation as gradual social adaptation.
Gradual social adaptation. It's the subtle creep of it all. What starts out as an aspirational treat quickly becomes the baseline normal. It's like how a harmless $5 weekly coffee habit somehow morphs into a $300 a month artisanal bean subscription.
And a home espresso machine that costs as much as a used car.
Exactly. Suddenly, private housing, overseas holidays, branded schools, and wellness spending are just the expected minimums of your daily life.
The new baseline.
As your income rises, your baseline spending rises right alongside it to absorb the excess. The result is that you don't actually feel wealthy. You just feel completely stretched.
Stretched and highly vulnerable. Which brings us to a massive conceptual error that many HIFIs make, even the highly educated ones.
Here's where it gets really interesting. So many high earners fundamentally confuse income with wealth.
It's the most common mistake.
The financial data draws a very sharp line between the two. Income is simply the cash flow that hits your bank account every month. Wealth is what remains after the lifestyle is funded. Wealth is what compounds over time in the background. And crucially, wealth is the engine that can eventually replace that earned income entirely.
That distinction is everything. You can earn an exceptionally large salary and still have incredibly weak financial resilience.
If it's all going out the door.
Right. If most of your incoming salary is immediately committed to servicing debt, or it's highly leveraged, or tied up in illiquid investments, you're walking a tightrope.
A very expensive tightrope.
The anxiety spikes because your entire beautifully curated lifestyle depends completely on your continued employment, your next annual bonus, or the broader economy always expanding.
But wait, let me play devil's advocate here for a second, especially regarding real estate.
Sure, go ahead.
For decades, we've been told that upgrading property is the absolute safest way to build generational wealth. It's tangible, it appreciates, and it forces you to save.
That's the traditional wisdom.
So why is the data suddenly telling us that this is a trap for the HIFI demographic?
It's a great question, and it's counterintuitive because real estate is historically a fantastic asset class. The trap isn't the property itself. It's the over-reliance on it and the leverage required to get it.
Okay, unpack that a bit.
When families constantly upgrade their primary residence to build wealth, they take on massive concentration risk. They end up with heavy debt obligations and severely reduced liquidity.
So all their money is trapped in the walls of their house?
Yes. Think of their financial life like a luxury cruise ship with absolutely no lifeboats. It looks magnificent on the surface, but it's highly vulnerable to a single leak.
Wow, that's a vivid image.
The classic HIFI scenario is being asset-rich on paper, maybe sitting on millions in home equity, yet cash flow tight in reality.
Because the mortgage is eating everything.
Exactly. If the bulk of your net worth is locked up in the bricks and mortar of the house you sleep in, and your monthly income is completely absorbed by the mortgage and maintenance, you lose all your flexibility. You can't slice off a piece of your roof to pay for a sudden medical emergency or a sudden bout of unemployment.
You essentially build a beautiful financial house of cards. And if one strong breeze comes along, a corporate restructuring, an illness, the whole thing shakes.
It comes crashing down.
But it's not just real estate where HIFIs run into trouble. Let's look at how they approach the financial markets. The research shows that being an active investor is definitely not the same thing as having an actual investment strategy.
Not at all. We see two very dangerous, emotion-driven extremes that HIFIs tend to fall into when they try to invest their way out of this creeping anxiety.
Let's hear the first one.
On one end of the spectrum, you have the speculators.
Ah, they're risk takers.
Right. These are high earners who constantly chase performance and follow the latest market narratives. They build highly concentrated positions in fashionable assets.
Things like trendy technology stocks, the latest crypto wave, that sort of thing.
Exactly. Or multiple highly leveraged investment properties. Because they lack a solid, grounded framework, they expose themselves to immense volatility and overconfidence. And that almost inevitably leads to painful drawdowns.
And for those listening, a painful drawdown isn't just a minor dip. We're talking about watching your portfolio value plummet 30 or 40% in a matter of weeks.
It's stomach churning.
Suddenly, that retirement date you had circled on the calendar gets pushed back an entire decade, which is psychologically devastating.
Precisely. And then, on the complete opposite end of the spectrum, you have the overly conservative investors.
The ones hiding their cash under the mattress.
Essentially, yes.
Yeah.
These are the folks who look at the volatility of a market, feel the crushing weight of their high fixed costs, and they just panic. So they hoard cash.
They're just terrified of losing what they've built.
Exactly. They stick exclusively to low-yield instruments, savings accounts, or short-term deposits purely out of an intense fear of losing their capital.
Yeah.
But by doing that, they fail to outpace inflation.
It's a silent wealth killer.
It really is. They are slowly but surely losing their purchasing power over time, ensuring they'll never build enough long-term capital to replace their high income.
Both of these extremes reflect the exact same underlying issue, don't they?
They do.
Their financial decisions are being driven by raw emotion rather than a deliberate structure. It's not a lack of effort. HFIs are usually very hardworking, highly intelligent professionals.
Often the smartest people in the room.
The problem is a lack of a framework. Without a clear understanding of their ultimate objectives, their true risk tolerance, their time horizon, and their actual cash flow needs, their portfolios end up totally disconnected from the realities of their lives.
That disconnection is what makes the future look so terrifying, especially when you realize what's coming down the pipeline for this demographic.
The demographic squeeze.
Yes, we're seeing something called the three-directional burden, and honestly, it sounds absolutely exhausting. We're talking about middle-aged earners who are getting severely squeezed from every possible side.
It's the ultimate sandwich generation problem, but magnified by modern costs.
Exactly. First, people are generally living longer, which is wonderful from a health perspective.
Of course.
But increased longevity means a much, much longer funding horizon for retirement. You have to make your capital last for decades longer than previous generations did.
You might be retired for 30 years.
Right. Second, while you're trying to stockpile cash for this extended retirement, medical costs and the costs of elder care are steadily rising at a rate much higher than standard inflation.
The healthcare inflation rate is brutal.
And third, these earners are stuck right in the middle. They're financially supporting their growing children, trying to fund those expensive educations and head starts in life.
While simultaneously having to step in and support their own aging parents.
Yes, parents who perhaps didn't save enough for their own extended lifespans.
So you're funding your kid's future, you're funding your parents' present, and you're desperately trying to save for a retirement that might last a third of a century, complete with rising healthcare premiums.
Good lot to carry.
When you lay it out like that, it's no wonder a massive salary feels completely inadequate. But it's not just the cold, hard math that makes this so stressful, is it?
No, it's not. If we connect this to the bigger picture, the financial anxiety of the HIFI is deeply psychological.
How so?
Well, financial peace is rarely determined by the sheer number of dollars you earn. It's shaped by uncertainty, your perceived level of control, and crucially, social comparison.
Keeping up with the Joneses.
But on steroids, we live in hyper-competitive, hyper-connected societies. High earners don't measure their success against national averages or historical baselines. They measure themselves against their immediate peers.
Right. You aren't comparing your house or your vacations to the average household in your country.
No, you're comparing them to the executive sitting in the glass office next to you.
Or the people posting their luxury European summers on your social media feeds.
And that's where the trap closes. When you're surrounded by equally successful households who seem to be progressing just a little bit faster,
They just bought the new Tesla.
right, or the kids are at a slightly more prestigious school, it's incredibly easy to feel like you're falling behind, even when objectively you're in the top 1% of earners globally.
It's wild to think about.
This social comparison quietly but powerfully erodes your life satisfaction. It reinforces a toxic, exhausting cycle where you feel like you must constantly keep earning more, keep upgrading your lifestyle, and just keep chasing the next visible milestone to prove you're doing okay.
So what does this all mean? We've painted a pretty stressful picture of the HIFI lifestyle. The high fixed costs, the leverage traps, emotional investing extremes, massive family burdens, and the utter exhaustion of keeping up with peers.
It is a lot, I know.
How does a high earner actually break this cycle? How do you take that great income and engineer it into an ironclad, resilient financial structure?
Fortunately, the research doesn't just diagnose the problem. It offers a really practical blueprint for resilience.
Like six-step deliberate path,
You know,
right?
And the overarching theme of this blueprint is that the solution is not simply go out and earn more money.
Earning more just feeds the beast.
Exactly. Earning more without a better structure just creates a larger, more expensive version of the exact same stressful cycle. What you actually need is clarity, intentionality, and deliberate design.
So if the first hurdle is just admitting that a high income isn't enough, what's step one? The first behavioral shift someone needs to make.
The data points to starting with a personal finance audit, but doing it in a very specific way.
Okay, lay it on us.
The key here is conducting an audit entirely without guilt.
No guilt. I like that.
It's not about opening your credit card statement and punishing yourself for buying a nice dinner. It's about revealing whether your spending genuinely aligns with your personal values.
Seeing where the money is actually going.
You have to sit down and ask yourself, does my current lifestyle reflect what actually matters most to me and my family? Or has it just become a default pattern shaped by convenience, habit, and societal expectation?
Just paying for things because everyone else does.
Right. You need to separate the truly essential expenses from the discretionary ones and brutally identify the expenses that have just become mindless bloat.
And once you have that clarity, you move to step two. You start restructuring. And this next phase is brilliant because it tackles the anxiety head on.
It really does.
It's about fundamentally separating how you fund your survival needs from how you fund your wants.
Think of it like building a medieval fortress. Your moat and your thick stone walls. That represents your absolute basic survival needs.
Your baseline.
That's your basic housing, your groceries, your utilities, and your essential medical care. You want to fund those core needs with the boring, bulletproof stuff.
Highly stable, conservative, income-producing assets.
Exactly. Reliable bonds or dependable annuities. You want guarantees there.
Right. And then the fancy tapestries inside the castle, the grand banquets, that represents your lifestyle want.
The luxury vacations, the restaurant dinners, the premium car upgrades.
So how do you fund those?
You fund the tapestries with your variable investment income, the stuff that fluctuates with the stock market. This layered approach is incredibly powerful for your psychological well-being.
Because you know your walls are secure.
By securing your base-level survival needs with dependable, conservative income, you dramatically reduce your emotional anxiety. When the stock market inevitably dips and the economy gets shaky, it might mean you have to skip a vacation to Italy.
But it absolutely doesn't mean you can't pay your mortgage or keep the lights on.
That specific structure stops market fluctuations from becoming emotionally destabilizing.
Which leads right into step 3, building that wealth engine. We talked earlier about the trap of having all your net worth tied up in one upgraded piece of real estate.
Yes, the liquidity trap.
To build a resilient portfolio, you have to move beyond that.
True diversification means spreading your risk across different asset classes. Equities, fixed income, real estate, perhaps some alternative investments.
Not just putting all your eggs in one basket.
It means diversifying across different geographies, not just having all your money tied to the economy of the country you happen to live in. And crucially, it means diversifying across different liquidity levels.
Having cash on hand.
You need assets you can sell tomorrow, if you need cash, alongside assets that are locked away for the long term. Diversification won't completely eliminate risk, but it massively improves your odds of surviving a localized economic shock.
Okay, let's talk about step 4, the stress test.
Yeah.
Because this is where I think a lot of people might nod along but not actually know what to do. The research says we need to stress test our leverage.
It's vital.
How does a listener actually execute a stress test on their own finances?
It's about running deliberate hypotheticals. Let's imagine a fictional HIFI family. They bring in $350,000 a year combined.
Okay, solid income.
They have a $10,000 a month mortgage, private school fees, and 2 leased cars. A stress test means sitting down at the kitchen table and asking, what happens if the primary earner loses their job tomorrow, and it takes 9 full months to find a replacement income?
Do we have a liquid cash to float that?
Exactly. Or what if interest rates stay high for the next decade and our mortgage payment jumps by 30%?
So you're literally throwing hypothetical rocks at your financial structure to see where the glass breaks.
I love that analogy, yes. What if you face a sudden, sharp spike in medical costs for an aging parent? If your financial plan only works under perfect, ideal sunny day conditions where everyone stays employed, nobody gets sick, and the market always goes up.
Then you don't actually have a robust plan.
True financial resilience is the ability to absorb life's inevitable shocks without tipping into panic or having to fire sell your assets.
That makes total sense. Now, for step 5. Once the fortress is secure and the stress tests are passed, what about taking risks? Because high earners often want to swing for the fences. They want to invest in the exciting stuff.
And they absolutely can. Taking speculative high-risk bets on an emerging technology, a new crypto project, or an angel investment in a friend's startup is totally fine.
Provided what?
Provided you can actually afford to lose every single penny of that money. The critical rule here is containment.
Keeping it separated.
Your speculative capital must be completely walled off from your core retirement portfolio. Your fundamental retirement security should never, ever depend on perfect market timing, getting lucky, or the continued success of a highly volatile asset.
It's the difference between investing and gambling. Don't gamble with the grocery money.
Exactly.
And that brings us to step 6, the final and perhaps the most difficult phase of this entire transformation. It requires a complete rewiring of how you view money. You have to actively redefine success.
This goes right back to the social comparison trap we discussed earlier. The ultimate goal of your financial life shouldn't be to look wealthy to your neighbors or your colleagues.
It shouldn't be about the optics.
No. The goal is to actually become secure. And as the data constantly reminds us, those are rarely the same thing.
Because the person with the newest car might be drowning in debt.
Precisely. Think about a household that has lower visible consumption. Maybe they drive reliable 5-year-old cars and they live in a slightly more modest house than their income would allow.
They don't look like they're rolling in it.
But behind the scenes, they have strong cash reserves, highly manageable debt, diversified liquid assets, and a crystal clear retirement framework.
They're sleeping soundly at night.
They are in a phenomenally stronger, much more powerful position than a household earning twice as much, but living under constant, grinding financial strain just to maintain the illusion of affluence.
It all comes down to realizing that financial adequacy isn't just a math equation based on the top line number of your salary. The big takeaway for you listening today is that lasting financial peace is achieved through structure, discipline, clear priorities, and built-in resilience.
It's an architecture you have to build.
You don't gain true peace just by negotiating a slightly higher bonus this year. You gain it by knowing that your financial life rests on a foundation that can endure whatever the world throws at it.
Exactly.
Think about how incredibly empowering it is to shift your own internal monologue. You get to go from lying awake at 3 a.m. wondering, will I have enough, to waking up and confidently saying, I know exactly what my plan is and I know exactly why it works.
This raises an important question for you to consider today.
What's that?
Look closely at your own balance sheet and your monthly cash flow. Are you actually building wealth that compounds in the background and provides future freedom? Or are you just the exhausted manager of a very, very expensive cash flow operation?
It's a confronting question, but such a necessary one to ask yourself if you want to break the cycle.
It is. And I want to leave you with one final thought to mull over as you think about your own financial structures.
Let's hear it.
We spend a lot of time today talking about the intense pressure of social comparison. What if the ultimate milestone of true financial freedom isn't actually the ability to buy whatever you want?
What is it then?
What if true freedom is the psychological peace of no longer caring what your peers are buying?
Wow, that is a brilliant place to leave it. Thank you so much for joining us on this deep dive. We highly encourage you to take a hard, honest look at your own financial structures, audit your lifestyle without the guilt, and start building that genuine resilience today. Until next time, take care and keep learning.